All right, well, we have Marko, Papic, Chief Strategist at BCA Research, joining us. Marko, good to have you with us here. Thank you very much. I hope you enjoyed your travels to Europe. I saw some stuff that you posted on social media. I think it was in Spain. What's the big sort of dominating driver, Marko, for markets? I mean, the US markets sold off aggressively on Friday. Is that a one-off thing? I mean, that options expiry, or, I mean, is it looking a little bit more durable in terms of a correction, a pullback? What's your sense?
Well, I think that actually your introduction explains it to viewers pretty well. I mean, it comes down to NVIDIA earnings on Wednesday, and the fact that it does come to NVIDIA earnings should tell you that it's not really good news for the US market. At the very least, I think investors can forget about the kind of double-digit S&P 500 returns we've seen the last 2 years. And so the question is, do the earnings of the tech stocks hold up? Other than that, the real enthusiasm, shockingly in many ways, is about emerging markets and Europe this year. The dollar seems to have really hit its secular peak. I mean, you see the euro's up very strong this morning as well, for you, morning in Asia, of course, given the German election results, which were largely known, but I think the euro is rallying nonetheless. And despite all the tariff, and trade war threats from the US administration, which should have supported the dollar and hurt global equities, they haven't done that. And I think that's because the biggest story out there is that US economy is going to surprise to the downside. I don't want to use the R word yet, but fiscal spending is not going to be what investors thought. And so some of the expectations of US leapfrogging the rest of the world are falling flat. So for the time being, it does remain really about the rest of the world, Europe, Asia, Japan, and the US lagging, and depending on Magnificent Seven continuing their pretty extraordinary run of earnings.
Okay, Marko, that's an interesting thought, that maybe it's not going to be all hunky-dory in the US, and we're seeing some signs of that, right? One is obviously this tariff issue, and there's almost near consensus that it'll raise costs for Americans. And the second, I don't know, I want to ask you this little bit of a non-market question, but whatever's happening within government, and the overnight headlines were, Dodge sending these emails to government employees saying, justify what you did this week or else you're fired. I mean, in not so many words. And I think a lot of the bigger agencies like FBI have stopped their employees from responding to that email. So some cracks also opening up. At the margin, is the worry in the US just about the tariff impact, or is there something more to it?
No, see, the tariffs should have helped the US. That's kind of the funny situation here. The whole reason why the dollar rallied since the middle of September, when President Trump started gaining in the polls, was the expectation that tariffs would hurt the rest of the world. And they can't really hurt the US that much. So you point out that they raise costs for consumers in the US. It's okay. US inflation was double digits in 2022. US outperformed the rest of the world. So that's not really a threat to the US. It's a threat to India. It's a threat to the rest of the world. But I think the markets are increasingly realizing that President Trump is not going to impose the kind of double-digit across-the-board tariffs that would really massively impact the rest of the world negatively. He's using the term reciprocal as an example, something that Indian viewers obviously understand very well. Prime Minister Modi went to Washington, D.C. There was this use of reciprocal tariffs. But why reciprocal? If President Trump really wanted to help finance the US government with tariffs, as he claims he wants to, then why not slap 100% tariff on India or anyone else? Reciprocal is an interesting choice, therefore, because it suggests that actually the intention here is not to permanently impose tariffs on the rest of the world, but actually get the rest of the world to lower their tariffs on US, and in return, US lowers their tariffs on the rest of the world. And that's why non-US markets are outperforming the US. This expectation that the tariffs will be permanent is kind of dissipating. As for your point about Doge and emails to federal government workers and bureaucrats, I think that's also feeding this expectation that fiscal policy will not be as stimulative. I mean, if you're cutting jobs in the government, you're also probably going to struggle to pass a very profligate, very huge bill that will expand the deficit. And I think that's taking the wind out of the sails of the US economy a little bit. Again, it doesn't have to be recessionary, And in fact, the fact that bond yields are coming down, as you pointed out earlier, could be stimulative in a 6 to 12-month horizon. But for the time being right now, it means U.S. economy underperforms the rest of the world.
Okay, all right. Hi, Marko. Good to hear that. And in fact, from an India equity market perspective, a couple of points out here. The dollar index, you think it's peaked out at around the 110, 111 odd mark, going by all that you had to say with regard to the US economy, how you see things shaping up on the tariff front as well. And the second point is India of late has underperformed. But, fundamentals actually in the longer term still look pretty much good from an India market perspective. Would you believe that Indian markets can outperform from here on, given the recent underperformance on the dollar index and your view on the Indian markets? Please go ahead.
Yeah, for sure. I mean, outperforming the US, I think that's going to be a relatively easy challenge. I know that's difficult to say after 15 years of American stellar performance. But again, I think at this point, US markets are really just hanging on the performance of Magnificent Seven. That's the last leg that they have. And so, yes, if fiscal policy surprises to the downside in the US, which I think it will, and if tariffs continue to be a tool of negotiating and not an across-the-board threat to the rest of the world, then I think the dollar is going to come down pretty significantly. And if the dollar comes down, I think that's beneficial for Indian assets, especially given their underperformance and a mini sell-off. So the biggest problem with Indian assets for the past, 1, 2, 3, 4, 5 years, really, the one thing that has hesitated anyone from buying Indian assets is valuation. And so it's positive that they've come down a little bit and they're entering into this low yield, low DXY environment, which should be helpful for India, but also other emerging markets. I would also point out that probably the highest upside in 2025, I mean, it's a high risk, high reward play, but Chinese equities could actually be a pretty surprising outcome, specifically because President Trump is starting to talk as if there's possibility of a China-US deal, maybe a phase 2, if you will. Now, again, it's not a really 6-month view, but I think on a 12, 18-month horizon, Chinese assets could actually be some of the best performing. And that will lift all emerging markets with it, even India. Even if India is not supposed to be high beta to China, it will help kind of move capital over to emerging markets en masse.
Got that, Marko. Just a 30-second response. Do you expect a Russia-Ukraine peace deal in the next 1 month?
Yes. That's better than 30 seconds. There you go.
You did that in 5. All right, that's good news. And maybe, our next conversation will pick up on that. And I'm sure we'll speak before that peace deal happens. And I would love to hear your thoughts on that as well. That's going to be the big one. That war has gone on for about, 2.5, 3 years. So finally, perhaps resolution in sight. What shape, form, impact, etc. we'll find out. Thank you very much, Marko. Appreciate you joining in. And great conversation as always.